let's talk about something a little provocative today. What if the single biggest risk to your investment portfolio isn't the market? What if it's you? What if your own confidence is actually the thing holding you back from your financial goals? We're going to dive into how our own brains can, believe it or not, lead us completely astray with our money.
So, first up, let's tackle this fascinating idea called the confidence paradox. It's this completely counterintuitive concept where the more sure you are that you're an amazing investor, the more likely you are to make some really expensive mistakes. And the data backing this up, it's pretty darn strong.
All right, so let me ask you a question, and I want you to be really honest with yourself. Do you think you can beat the market? I mean, do you genuinely believe you've got what it takes to pick the winning stocks, time the trades just right, and consistently come out on top?
Well, if you said yes, you are definitely not alone. It turns out that a whopping 68% of Indian retail investors believe they can outperform the market. But here's the kicker. The data shows that the vast majority of those same investors actually end up making less than a simple, boring index fund. That is a huge gap between how good we think we are and how we actually perform.
So why? Why is there such a massive disconnect? Well, it all comes down to how our brains are wired. There's this whole field called behavioral finance that's figured out we all have these mental shortcuts, these, you could call them blind spots or cognitive biases that cause us to make some pretty irrational decisions with our money. Let's meet a few of the biggest culprits.
The first one, and you could argue it's the most dangerous of all, is the overconfidence bias. This is that little voice in your head that says, I got this, I know where the market is going. It makes us seriously overestimate our own skill and completely underestimate the role of pure, simple luck.
And what does that look like in the real world? Well, it looks like trading way too often, racking up fees and taxes that eat into your returns. It looks like putting all your eggs in one basket because you're so sure about that one stock. And oh, this is a big one. It looks like holding on to a losing investment, not for any good financial reason, but because selling it would mean admitting you were wrong.
Okay, next up is a really sneaky one, anchoring bias. This is a powerful little mental trap. Your brain grabs the first piece of info it gets, and for investors, that's almost always the price you paid for a stock, and it drops that down like an anchor. From that point on, every decision you make about that stock is mentally tied to that first number, even if that number is completely irrelevant now.
Sound familiar? You look at a stock that's down, say, 30%, and instead of asking, is this a good investment today, your brain just says, ugh, I can't sell it for a loss. I'll just wait until it gets back to my price. That's the anchor talking. It's chaining you to a decision you made in the past, and it's stopping you from making a smart one in the present.
And then, of course, we've got to talk about herd mentality. You know, we're social creatures. We're literally hardwired to want to stick with the crowd. In investing, this shows up as a massive fear of missing out, that classic FOMO. We see everyone else piling into a hot stock, and we just can't help ourselves. We toss our own research out the window and just follow the herd.
And you can probably guess where this leads, right? It's a total disaster. Following the herd means you're chasing stocks that have already gone up a ton, so you're buying at the top. And even worse, when the herd gets spooked and stampedes for the exit, you panic and sell with them, locking in your losses right at the bottom. It's the perfect recipe for buying high and selling low every single time. Now, it's so important to get this. These biases aren't just little personality quirks. They are active, destructive forces. I like to call them compounding killers because they systematically destroy the single most powerful wealth-building tool you have, the magic of compounding. Think about it. Compounding works its magic through patience, discipline, and just leaving your money alone to grow. But what do all these biases make us do? The exact opposite. They push us to be impatient, to make emotional decisions, and to constantly fiddle with our investments. They're literally an anti-compounding strategy. So you really end up with two completely different paths for your portfolio. On one side, you've got this chaotic, emotional path driven by biases. You trade too much, you chase whatever's hot, you cling to your mistakes. And on the other side, you have a calm, rational, disciplined approach. One path feels exciting, for sure, but only one of them actually builds long-term wealth. And this all leads perfectly to this incredible insight from the author Morgan Housel. He says, the biggest investing edge isn't IQ or market knowledge, it's behavioral discipline and patience. It's not about being the smartest person in the room. It's not about having some secret tip. The real, lasting advantage is just mastering your own behavior. So, if the problem is literally inside our own heads, what's the solution? Well, it's not trying to become a robot without emotions.
That's impossible. The solution is to build a system, an antidote to our own impulses. Basically, a way to protect you from yourself.
And here are 3 incredibly simple but powerful ways to do that. First, invest systematically. Use things like SIPs. Put your investing on autopilot so that emotion doesn't even have a chance to get involved. Second, create a written investment plan. Write down your rules before things get crazy, when you're still calm and rational. And third, and this one is tough, I know, limit how often you check your portfolio. The less you look, the less you'll be tempted to react to every little market bump.
Which brings us right to the end, to the most important takeaway of all. The real secret to success in investing over the long haul, it's not found in a stock chart or an expert's forecast. It's found in managing your own behavior.
And that's the bottom line, really. Stop trying to outsmart the market. That's a game you probably can't win. The real game, the one you can win, is recognizing the tricky ways your own mind works and building a simple system to outsmart your own brain.
So, I'll leave you with this one question to really think about. Look back at the last few big investment decisions you made. Were they driven by a cool, calm, rational plan? Or were they driven by a feeling, by confidence or fear, or just pure excitement? Answering that question honestly might be the most valuable financial insight you ever get.